Right, well, thank you very much. Great pleasure to be able to exchange ideas with you all again, and particularly after such stimulating papers earlier, to follow up on these. The question that I was asked to talk about was, why regulate the financial system and how? Now, goodness me, it's not that long since the crisis. Why are we having to justify talking about regulating the banking system? You'd think, well, okay, we've been there, the case is proven. But it's clear that we do still have to discuss why we want to regulate the banking system, and then, of course, how we want to go about it. We see regulation being rolled back in the States already with the regulation that was introduced after the crisis, that's being pulled back. But we've had a very good account of the problems posed by the massive unregulated shadow banking within the system and how that's building up pressures for the next crisis. So it is, unfortunately, still an important thing to do to justify, as I want to do, regulating banking. Now, how I want to do this is to go through different perspectives. I'm going back to first principles. Why do we regulate the banking system in the first place? But there are different theoretical perspectives on this, and these have informed the policy debate as well. So I want to look at these different perspectives at a fairly fundamental level in order then to justify, from a post-Keynesian point of view, why regulating the banking system is definitely something that we should be focusing on. So this is pluralism in action. What I'm trying to do is to understand, as well as I can, the basis for other positions on regulation. I respect the fact that there are different positions coming from different understandings of how the world works. The fact is that everybody has an understanding of how the world works. Different political positions have different understandings. Different theoretical positions within economics are based on different understandings about how the world works. But just because I respect difference and I want to understand difference doesn't mean to say I can't try to justify my own point of view. But I recognize it's a matter of persuasion. So what I want to do is to persuade you to take seriously the post-Keynesian position on bank regulation. And this involves an understanding in particular of how the financial system works, how it relates to the real economy, what the role of the central bank is, and therefore, if you're an economist, how you build theory about it all. So there are many points of view on this, but given the current debate, I've picked 4 points of view, and I'll go through each of them in turn. And the first is starting at one extreme of a sort of libertarian position. This is the neo-Austrian approach to regulation, which owes a tremendous debt to Hayek. The second position is the new Keynesian position, which doesn't have much to do with Keynes, actually. I'll explain what this involves. But this is a particularly important one to take seriously because it's provided the basis of much of the mainstream debate about regulation and the way in which policy has been designed. The third one is partly new, partly very old, the sovereign money position. This is just the latest version of a position which advocates a state monopoly on money. It appears in different guises. I've just picked sovereign money because I think it's the latest term that's been used. But that's obviously the polar opposite of the Austrian view. And then finally, I want to explain the post-Keynesian view, which differs in some very fundamental respects from the other three, and particularly in respects which relate very much to the previous session and the role of the market in finance. So let's start with the new Austrian approach. Should there be bank regulation? Well, neo-Austrians think that financial problems actually originate with the state. So the state is the last body you want to get involved in market activity within the financial sector. As far as inflation, monetary stability is concerned, Austrians will argue that inflationary periods in the past have been caused by governments succumbing to political arguments to subsidize wars or reduce unemployment before elections, that kind of thing. So we want to take the state out of money creation from that point of view. And in the financial sector, the argument is that the state, again, has been the source of all our problems. And this argument actually has been a very powerful one in the wake of the crisis. The argument is that market incentives have been distorted by the state. In particular, the fact that the state stands ready as lender of last resort to provide liquidity when there's a crisis encourages banks to take on too much risk. It's the too big to fail problem. So again, the state is the problem, it's not the solution. Ironically, Hayek was an advisor to the Thatcher government in Britain. I was thinking about this when we saw the slide this morning about interest rates peaking under Mrs. Thatcher. That was Hayek. He said, okay, there's inflation. This is because too much money has been created for political purposes. The best thing to do is get rid of it as soon as you can. He wanted a sharp shock. Put interest rates up really, really high, and that will shock the economy and it will go back to a stable market-based situation. And I've provided a quote at the end of the slide from Hayek when he says, the state does have a role, but it's like a gardener clearing the weeds. A market-based economy is an economy where the plants that you want can flourish. And if you want to try and help this along, then you want to try and clear the weeds away. And this is the sole role that money should have, that governments should have. And he went so far as to argue that actually the state shouldn't be involved in money at all. We shouldn't even have central banks. Money should be the liability of private sector institutions. And then these monies would compete. The market would decide which are the safest ones, and that would ensure financial stability. So it's seeing failure of banks from a very microeconomic perspective, that if a bank gets in trouble, it's an isolated incident. We, the customers, see the value of our deposits threatened if the bank is likely to fail. We take our deposits away, we give them to banks we think that are better, and that keeps the banks on their toes. There's no lender of last resort facility as a backstop. The market ensures that the system is stable. So this is the neo-Austrian approach to bank regulation, which is don't. Okay. Now, if I was a neo-Austrian, we wouldn't be here very long because that would be the end of it. But now we come to the new Keynesian approach. And this is the dominant mainstream approach within discussions about financial regulation. It's the successor of, first of all, the monetarist approach, and then the new classical approach. This is now the mainstream approach, which is most commonly used when we're discussing problems of monetary instability and financial instability. The emphasis from this point of view is the standard one, that the role of central banks is to control inflation. Okay, there's usually something else in the charter for a central bank about financial instability, but the argument is if you can create monetary stability, then that will ensure financial stability. Except that there are weeds in the free market garden. There are market imperfections, things that stop it working properly. And this is the role of government. This is where regulation is actually required to try to counteract these imperfections. Now, the standard imperfection that neo-Austrians talk about is asymmetric information. That knowledge of risk attached to borrowing is concealed from lenders, and that encourages credit rationing. Now, you notice what I said, the knowledge about the risk is concealed. It's there, it's just concealed. So we have a situation where, in principle, we can measure true risk. We have the ingredients for a pure market system. But these asymmetries within the system, naughty borrowers keeping back information, stop the system from working properly. I mean, I honestly find this bizarre having if you look at the banking literature, well, the literature about banking, not the new Keynesian banking literature, there's all sorts of stuff about banks giving advice to borrowers about how to organize their finances. So the idea that borrowers are so savvy that they can conceal information seems a bit bizarre. But anyway, that's one problem. A second problem which has been much more significant I should before I go on to that, I should say, that was significant in the crisis because all sorts of information was concealed in these structured products. Again, bizarre, rational economic man, what on earth were they doing not asking about these products? Well, okay, the argument is that for various reasons, full information was not available about the nature of risk, and this created instability. But the second one was the too big to fail problem, which created systemic risk. Now, this in a way is a very constructive development within this approach to recognize the problem of interconnectedness within the financial sector, such that failure of one institution may well, through network effects, cause failure in other institutions, ultimately leading to a crisis. And this has been quite important in underpinning a lot of the regulatory reform that we've experienced. And then, again, we have the moral hazard problem. Now, why do we still have the moral hazard problem? Well, a lot of it is because of the political failure of governments to have the guts to allow big institutions to fail. It's a reflection of the power of these large banks, just as large corporations, that governments are afraid to let them fail. A lot of that is for good reason, because of the systemic effects, which we saw with Lehman Brothers, the systemic effects of allowing large failures. But there's been no sign that governments are willing to move away from that position. And so from a new Keynesian perspective, we still have this market failure. We still have this excessive risk being taken on by the financial sector because the government is continuing to act as a backstop. And if only you could somehow move away from that position, then a lot of this regulation wouldn't actually be necessary. So there has been a lot of re-regulation since the financial crisis. At the micro level, microprudential regulation, trying to ensure individual banks behave more prudently in their lending, loan-to-value ratios and so on, higher capital ratios. There's been macroprudential regulation, stress testing to take account of the interdependencies between institutions, recognizing the dangers of systemic risk. But it's important to have at the back of our minds when we're looking at this that there's still this sense that if only we could sort of clear away all these imperfections, then we could really just leave it to the market, that the market is efficient, would be allowed to be efficient. And that stems from the view that true risk is accessible and can be priced into the market, and that allows market to be efficient. So there are these elements in common with the neo-Austrian approach. So a lot of these regulatory reforms are welcome from a variety of perspectives, but looking forward and thinking about current and future developments, it is important to remember that there is this ultimate faith in what markets can do if they're given complete scope. Now, the sovereign money approach, it's positive money approach. There are various other names and different forms that this approach takes, which is gaining an influence, I would say. I mean, there are people at the Bank of England, for example, who are interested in pursuing this kind of approach. But it follows in the tradition of ideas that were that emerged during the 1930s. Some had been, Gesell's ideas had been around before, but they were really picked up as a very important set of ideas in the 1930s to try to address the fact that the banks had created the Depression. The idea was that it was bank credit creation that created the bubble, which then burst. And if only we could stop banks doing this, then we would no longer have to worry about the financial system. And so the solution to that was to bring money creation fully within the state's control. Don't let banks have the freedom to create credit on minimal reserves. Or now, we think of the money supplies being endogenous. It's not sort of infinite, but it's been a very current train within the discussion after the crisis, the power of banks to create credit and how this limits the power of the state. So the idea is that the state should have a monopoly on money. Banks should not be allowed to create money. And these schemes take various forms. One form is for us as the general public to have accounts with the central bank, and rather than cash, we would get digital money through these accounts, and payments should be organized through these accounts, which of course completely removes the standard model of banking. Banks as we know it would cease to exist, and what we'd be left with are financial intermediaries, but ones that can still, sorry, I'm moving ahead of myself here. The idea is that we'd be left with financial intermediaries and a purely market-driven system. One of the proposals actually is that rather than the state providing money, money should take the form of a mutual fund. In other words, it should be, it itself should vary in value with market prices. And this is kind of similar to the neo-Austrian view, which is that the liabilities of banks or bank deposits should vary with the value of the bank's assets. I mean, this is what's implied if you take the state out of money creation. But otherwise, I mean, these proposals differ in various ways, but generally speaking, the rest of the financial sector is to be left to its own devices. The implication is if you can sort out money, then you've sorted financial instability. And private sector financial institutions can ensure stability through market forces on their own. So again, we have this idea that true risk is something that we can calculate and that it's knowable and it's available to markets as the basis for pricing. And therefore we can rely on markets. Now, I'm going to move on to the post-Keynesian approach. There are some elements in common between the sovereign money approach and the post-Keynesian approach. One is that the central bank, according to some of these proposals, has a broader remit than controlling inflation. I mean, inflation's still viewed as something controlled by the money supply, like the previous two. But in creating money, the state may be able to pursue other goals, social goals, environmental goals, as well as directing credit towards particular industries. So that's something that's common also with the post-Keynesian approach, that the central bank is seen as playing a wider role. And also the idea that the money supply is endogenous within the private banking system at the moment, that's also a core element of the post-Keynesian approach. But there are fundamental differences. I mean, sorry, I'm just realizing I put on this slide this quote from Keynes. I mean, Keynes is the primary inspiration for the post-Keynesian approach. And the view of central banking follows Keynes's priorities, which are to create full employment and an equitable distribution of income and wealth. Okay, so he had these social goals, he had goals about individual liberty, but he had social justice as very much at the core of his policy agenda. And as far as the central bank is concerned, central banks can assist in pursuing these goals by supporting the government in creating economic stability by having low interest rates, by supporting investors by having stable interest rates and a stable financial sector. And if you do all that, if you've got economic stability, you get financial stability, you'll get monetary stability at the end. That was the least of the issues. It's at the core of central banking for the other perspectives, but for the post-Keynesian perspective, controlling inflation is the least of our problems, and you're more likely to achieve it through promoting financial stability and economic stability. I mean, if you don't have a monetarist theory of inflation, then it's really tough for central banks to control inflation directly anyway, so you might as well face up to doing it indirectly. Now, money was central to Keynes's macroeconomic theory. And money was important. It's important as a means of payment, but really what was most important as money was that it was a safe asset. I mean, money by definition is a safe asset. Different assets can perform money functions. We've heard about the different moneyness of different assets. Some are more money-like than others. But society needs to have a safe asset. So from that point of view, the idea that money is itself marketized in its value varies. I mean, if we think in terms of the new Austrian approach, that the value of our regular bank deposits varies from day to day, or, I mean, even more if we start talking about shadow money, then that asset is not satisfying our need for money. And we need money as a safe asset. Firstly, we need something to denominate contracts. We need something to denominate labor contracts, and we need something to denominate debt contracts. So we need some kind of core to the system, some sort of fixed point on the basis of which our capitalist structure is built. But we also need a safe asset to hold when uncertainty rises. Because the Keynesian view is that capitalist economies are inherently unstable, then there are going to be ups and downs. No matter how well the government tries to moderate these cycles, there is going to be instability. There are going to be periods of increasing uncertainty, and we need something to satisfy our liquidity preference. We need something as a safe asset. So it's a core function of government to make sure that we have that safe asset. But the state can't, however appealing it might be to think that the state can have a monopoly in money, just sort of keep it within its control and make sure it's safe and keep us happy, in practice, this can't work. And this is something that Keynes himself wrote about in the 1930s, when these ideas were current then. And there are two reasons why it won't work. One is the state can't handle the idea that liquidity preference goes through discrete changes. Uncertainty can increase dramatically without warning, and that encourages a rush towards liquidity. Now, if the central bank has controlled the amount of money in the system, then it's going to be very difficult to deal with that. But secondly, and critically, the private sector will, and always has, create its own alternative monies. I mean, we saw that during the monetarist period, when the state tried to control the money supply through monetarist policies. The private sector financial institutions developed new kinds of assets which were near monies, did just about as well as state money. And so the same would happen again. I mean, we see this happening over and over again. I mean, the whole shadow banking development it just illustrates perfectly the way in which the private sector is so clever, so innovative in developing new instruments and keeping ahead of the authorities who they see as being costly. So instead of the state keeping control over the supply of money, the post-Keynesian position is what you need, the best route is to take advantage of the fact that traditional retail banking is an extraordinarily useful way of organizing the supply of money and the provision of credit for real economic purposes. In other words, the policy should be to try and separate off retail banking again from investment banking and all sorts of other types of banking. And this is something that's being implemented in the UK to some extent at the moment. So, I mean, the idea of the social contract was mentioned before. What we need is a return to the idea that the banks accept tight regulation, monitoring, supervision in exchange for the wonderful profit-making opportunity of having the support of the central bank to allow them to create credit. I mean, that social contract worked for a long time, and it just broke down in the 70s when the banks took fright at all the competition that was coming from new institutions taking their markets. They wanted to be out there, and they felt constrained by central banks. And central banks forgot themselves about the social contract. They forgot that there had been this deal with the banks. So they allowed the banks to go off and expand into all these areas, create the crisis. But then they forgot their side of the deal as well, because they forgot, particularly the Bank of England in the first instant, forgot that they were supposed to provide support to the banking system. So the governor of the Bank of England initially said, oh no, we're not going to support you. That encourages moral hazard. I mean, very quickly, he realized this was not a good idea and needed to provide support. But that's at the core of the post-Keynesian approach to regulation is that, number one, you want to make sure that society has money, and you set up a regulatory structure to allow that. The second key element is the role of uncertainty. I mean, I've mentioned how in the other three approaches there is this presumption that we can know true risk. Now, Keynes's philosophy, and therefore his economics, was all based on the argument that the future is uncertain. We can't quantify risk. We can form opinions about it. We can say it might be higher or lower, but we don't have the basis to precisely quantify it. Keynes said, in terms of companies making investment decisions, if they were actually rational in that sense, requiring full information and full knowledge of risk, they would never invest. I mean, there's all sorts of psychology literature sort of supporting this now, that we form our judgments the best way we can, as cleverly as we can, with as much information as we can, but we need to supplement information with knowledge, a feel for the situation, following convention if we can't think of anything else, following the gurus if we can't think of anything else. I mean, this is how we conduct our daily lives, isn't it? I mean, just like investors, we don't know what's going to happen this afternoon, do we? But we get by. You know, we have these conventions, we have these routines which allow us to function. And the financial market is no different. And there's sociological studies of how financial markets actually operate. And yet, as we've seen, we have this proliferation of marketization of finance, which presumes that we can reasonably price risk. Now, there are all sorts of issues on the table now. I mean, unfortunately, regulation is still on the table, but there's some particular issues on the table which I'd just like to go through, because these are some current issues and things that some of them have cropped up yesterday and earlier today. The first one is the idea of imposing a tax on financial transactions, a Tobin tax, a Robin Hood tax. You know, rather than marketizing you know, a project to build a bridge in a developing country, you raise money through an international financial transactions tax and allocate it according to need. Now, of course, this causes horror within the financial sector. To reduce efficiency. Well, yes, that's the point. Sand in the wheels. Keynes argued for that. He said the financial sector is far too efficient in its own terms, and that's why you get all these building up of instability and, you know, asset sales causing fire sales, rippling through the system at alarming speed. What you need to try and reduce that type of efficiency is to try and slow it all down in order to create a system that's more efficient in providing for society's needs, which is ultimately what we ought to be interested in. And taxing financial transactions is one way of going about that. This business of sorry, I won't put it that way. Let me say what I'm going to say by moving on to the next topic, which is cooperative banking, something that sort of cropped up yesterday and again today. The idea of different types of banking, and in particular, the fact that small local banks are really suffering under the current burdens of regulation. Now, it's a methodological and conceptual feature of post-Keynesian thinking that we look at interconnections between things, that we don't look at separabilities between the state and the market, for example, that we see the two as intertwined. And yet, when it comes to looking at the financial system and trying to put brakes on the system, there is a strong argument for going back to the old idea of segmenting the financial system. I mean, I've talked about segmenting between retail and investment banking, but we can talk much more generally about segmenting the financial system, putting up walls between them. Again, shock horror reduces efficiency, reduces profit opportunities, and yet that has the potential for putting brakes on systemic fragility and allows for us to think in terms of a financial sector addressed to particular needs. So that, for example, we can have small cooperative local banks performing one function, we can have mid-sized banks performing another function, and maybe not have large retail banks. Maybe just not have them. You know, so the large institutions are the ones that are engaged in the other types of activity and which would not be supported in the same way as the retail banks. I mean, as has been suggested, we could think in terms of a market maker of last resort to support shadow banking, but we have a lender of last resort for retail banking. So while the neoliberal agenda and the liberalization of finance from the 1970s tried to make everything one big melting pot, you know, cross currents through market pricing and so on. Instead, we would go for a segmentation between different types of banking. Now, the third topic, and indeed the fourth, is something that we were talking about quite a lot yesterday. And there were two, in particular, two interesting papers specifically addressed to digital currencies and well, well, I think there are 3 papers dealing with it. Now, what are we to make of digital currencies or cryptocurrencies in terms of financial instability and the role of regulation? First of all, are these actually monies? Now, some people have gone through the functions of money and argued that no, they do not perform the functions of money. I mean, this is it's a useful exercise to go through to think about them in these terms. A, they're not very good for buying commodities. Bitcoin had to fork off a new cryptocurrency called, oh gosh, I forgot what it was called. Anyway, another one for performing transactions because Bitcoin was so cumbersome. They're not very good as a unit of account because their value keeps changing, and each currency has a different value depending on which website you look at. I mean, this might change, of course, but at the moment, it's very hard to see a digital currency acting as a unit of account or as a store of value, given the way in which their market price is so volatile. But in any case, I mean, we talk about Bitcoin, but that's just one. It's a big one. But there are thousands of these digital currencies. You know, maybe a new Austrian would say, well, competition will ensure that Bitcoin is the one that survives, and that would be the money. But at the moment, there are so many proliferations, and there are side markets developing up in derivatives and in relation to cryptocurrencies and so on. One thing that's interesting, though, is, I mean, thinking of whether we can distinguish so clearly between the state and the market, is that there is some self-regulation going on. Bitcoin has set a limit on its supply, for example, like central banks are supposed to do. Bitflyer has limits so that purchases on margin are have to be unwound if the price varies by a certain proportion of the margin that's been put up. In other words, attention's been paid to where there's going to be likelihood to default. I mean, this is like the Scottish banking system, which was a private sector banking system, where the older banks actually developed central banking functions. I mean, it is actually possible for the private sector to develop central banking functions. But that's only when it works. I mean, that was a small, cohesive society where there was lots of trust. The general principle, the general experience from history is that it's very unwise to rely on this as providing a basis for securing stable value. Now, I've got 2 minutes, and there's the whole issue of the state issue of digital currency, because, of course, this is a sort of further issue that arises from the sovereign money approach. What if that money were to be digital currency? Well, just very quickly, what I can say is that actually these are separable issues. The technology that's used for a state currency is one thing, whether you have a state currency is another. So in a way, I mean, the Bank of Canada conducted experiments and concluded that the technology of digital currencies wasn't worth the effort that was going to be required to set it up. That was Project Jasper. But there is still the live question of whether central banks should issue money in the form of digital currency. So, conclusion. So where we are from a post-Keynesian point of view, just to sum up, is that our regulatory focus needs to be, first of all, on providing society with a safe money asset. That's number one priority. And that the best way of doing that is to try to get back to the old social contract between retail banks and the authorities. This is necessary and in relation to the other approaches, because the other approaches assume away uncertainty. If there's uncertainty, then we have to be very worried about marketization. The more financial markets are, the more financial relations are marketized, and the more economic relations are marketized, the more of a burden is put on risk assessment, and the capability isn't there to assess risk. So we do that at our peril. And therefore, the solution, I mean, it's easy to say, harder to do, but the solution is to pay a lot of attention, not worry actually so much about central banks creating money, which I don't think is at the core of it addresses the core problem, but concentrate really seriously on what's going on in the rest of the financial sector. Shadow banking is by definition unregulated. Well, should be regulated. As history shows, there'll be another shadow banking system. Well, keep an eye on that and regulate that too. Easier said than done. But honestly, hearing about what's happened in Norway really cheers me, because you make these arguments and you think, well, it's all very well to say these things. Well, we've seen in Norway, you can regulate the banking system and keep it stable. So there is hope. Thank you.
What a pleasure and a privilege to be able to follow and respond to Sheila's talk and the earlier conversations today, which have been some of my favorite people on these topics. To get them here to talk together is just an absolute pleasure. I'm going to start with the framing of the panel. I have a little bit of a problem with the word regulation as a lawyer, because all monetary and financial systems and markets are legally constructed. So to me, there's no such thing as regulation and non-regulation. There's just law and legal design and legal architecture and legal practices. Or as the poet Rilke once said, don't be confused by the surfaces. In the depths, everything becomes law. I say that as a lawyer, I'm kind of disciplinarily biased, but I think the point is still important to make at a place like this. Just to give some examples. There's property rights, like I mentioned yesterday. You can't have markets without having things that you own to trade. There's contracts, not only just allowing people to make contracts, but the fine nuanced legal details about contracts, including whether we allow rehypothecation or we allow people to incur some sort of insurance liability that then can be turned into a form of money. Anytime there's a contract, there's a form of credit risk. There's accounting laws, there's collateral analysis laws, there's criminal law about when people are engaging in fraud, there's bankruptcy law, tax law, financial instruments and payments law, there's the law of debt versus equity preference in tax treatments, there's the law of securities regulation and what counts as an ICO, there's the law of corporations and banks as particularly chartered entities that have special privileges and responsibilities. There's constitutional law and jurisdictional issues about where a bank account is and where a company is engaging in certain activities and therefore what law should apply. There's the law of the individual citizen or a person. Are you a citizen? Are you able to engage in certain activities like a home? Are you mentally competent? Are you an adult? Are you legally unencumbered by other debts that allow you to engage in certain behavior? Are you the kind of person that has a credit score that's legally recognized that allows you to engage in certain types of financial behavior? Are you in a system that allows private ownership of certain kinds of land and property or creates intellectual property rights that didn't previously exist? When you have an organization, are you engaging in employer relations with employees for certain activity and taking some aspect of the value that they create under those laws? So I don't think we can talk about regulation and deregulation as sort of good or bad. It's a matter of what we're doing with the legal design and what we're trying to achieve. And the reason I think that's important, I talked about the state yesterday, but the semiotics of law are a little bit more democratic, in my opinion. Not in terms of we can vote and therefore there's a democracy, but the idea of the state is something over there, it's foreign, it's external, it's hierarchical, But when you engage in daily behavior, you're engaging in lawmaking. You're participating in the legal system as an actor. Anyone can create law. The only challenge is to get it accepted. So when we think about law, we think about power relations and we think about our position in society, which gets us to the kind of really important questions that I think some of the other speakers here were trying to point out earlier in terms of shadow banking. The other word here is finance, modern finance. My talk yesterday began with a 5,000-year interpretation of the term modern money, and I define finance as distinct from money as a historically and technologically specific or contingent manifestation of monetary logic and dynamics. So fast forwarding from the primordial 5,000 years ago through to the cutting edge of the present and the future, I think about conversations of the future of modern finance as another way of talking about the future of money in itself. And again, like with changing from state to law, I think there's something a little more democratic or egalitarian about framing conversations about finance, the word which for most people is scary, technocratic, foreign, and talking about money, the kind of thing you have in your pocket, which everybody likes to talk or think about, or whether they like to think about it, they certainly are. So I see money also as something that is deeper than finance. There are aspects of money that can't be described solely in terms of finance. So money is a conceptually bigger and deeper project, and as a self-identified radical, which as Angela Davis said is just somebody trying to grasp at the root of the nature of things, I think we need to start with reimagining the future of money, and then we'll get an idea about how we can reimagine the future of finance in particular. So, regulation as a specific case of legal reform, finance as a specific case of monetary design. I agree with everything that Sheila was saying about the other different schools of thought. I come here as a post-Keynesian ally, fellow traveller, whatever you want to call it. I have one friendly critique about that, which is just that please invite more lawyers in the future. If you have Rethinking Finance and Rethinking Economics, and we're going to have Rethinking Accounting, which I'm super excited for, I'm there, we also need Rethinking Law. Because, just to give one example, there are aspects of financial and monetary systems and dynamics that can't really be explained in economic logic. There's an economic function, but the form also shapes the experience. So the example is just the difference between giving someone an account at a central bank and giving someone a digital instrument that functions like cash. From the point of transactions, maybe they're pretty close to the same. But from the point of view of privacy, civil liberties, political freedom, they have entirely different structural implications. So if you ask an economist, they might say, I don't really care, either one does the job. If you ask a lawyer or a civil liberties advocate, they might say, oh my God, what are you about to do if you get rid of cash, even if you give everyone a central bank account? Their issue isn't economic safety or the security, the asset principle. Their concern is whether or not we're going to have a totalitarian state where we can dream of anything other than dreary capitalism until the end of humanity, which might be soon, let me think. But so I think the idea of legal design of money and finance is also something we need to think about, more comprehensively. Now, from that point of view, there was actually a heterodox-orthodox fight in legal academia in about the 20s and 30s, certainly in the US. I know it hasn't filtered out to certain other legal cultures in countries over here, but in many respects, the heterodox group won in that time. The legal realists were next to the institutionalist economists, and whereas the institutionalists sort of got marginalized a generation later, as to sort of borrow Richard Nixon's quote, in America, everyone's a legal realist now. And legal realism is a sort of similar attempt, like with rethinking, to denaturalize certain ideas and beliefs about how law works and the formal relationship between legal structure and power relations. Sort of saying, let's be honest about the politics here. Let's be honest about the winners and losers in what we're designing. And let's be honest that when we say we're just interpreting the world, we're really changing it on an ongoing basis. So my vision of the future of finance, or the future of regulating finance in the digital space, rather than go into each individual issue and sort of talk about them, I'm going to try and just sort of, let's do a thought experiment. Imagine, I don't know if you've seen Ready Player One, don't, but do if you want to, but the idea of starting in a world where we're all in a computer game for a second. We're all in the whole world, in a space together. There is still, you have an avatar, you can walk around in that space and things, but you're a digital representation of yourself. There's no meat sack covering your brain. And in that space, you can be a part of a country, you can have a job, there's a tax circuit, so you're unemployed still, God forbid. And there's a digital currency created by the authority in whatever jurisdiction or place your avatar is inhabiting. So to go back to our story yesterday, we're still in a modern money world, just a digital one. In that place, there's a digital currency token or unit that is secure, like a file you can't copy on your computer, or if you try to copy, it won't work. In that context, that functions in a way that cash functions in our pocket today. It's issued by the issuer, it's safe, and it moves with us. There is no account, there is no tracking it. There's a barcode or an equivalent of a barcode, but there is no way for some account manager to lock down your account if you are protesting the Arab Spring or something like that. Or if you're, Donald Trump's new worst enemy this week. So in that place, we have a token that is difficult to counterfeit. Maybe there are limits to the anonymity. I think maybe there shouldn't be, but maybe up to $100 or $100 or $1,000 or something, it's anonymous. After that, you are required legally to register that money, with an account or something. But that's not technically forced. In the same way as with cash, you're not legally allowed to take more than $10,000 on a plane, but there's nothing in the cash that's going to start beeping when you go through the security at the airport. The cash doesn't know what's going on. That's a question for the lawyers and the regulators. So in that place, anybody could hold as many of those assets as they wanted in their pocket, including a shadow bank. That issue of deposit insurance limits that Daniela was talking about that often, to certain people like Zoltan Pozak, precipitated a lot of the move into shadow finance and the need for near monies and safe alternatives or nearly safe alternatives would go away. You could hold $5 trillion of cash in your pocket. If you wanted to put it in one of those accounts as an institutional investor so that you're not committing corporate fraud or something, there might be an interest rate on that account that the government sets. In the same way as the government sets the interest rates on treasury securities through its monetary and fiscal operations. Maybe different actors would get different interest rates. Maybe pensioners would get a certain rate according to public policy needs. Maybe homeowners and individual families would get a rate. Maybe large institutional investors would get a rate. Maybe there would be an account for every other bit of money that you wanted to store there that wouldn't earn a rate. So if you close your eyes for a minute, you've got your cash in your pocket, you've got your checking account, and you've got whatever savings accounts you want with the interest rate set as a matter of public policy. So in that place, the accounts might be managed by the central bank, but you could have a whole range of applications and various entities creating the equivalent of a skin, or if you have an email with your university, but you might use Outlook or Gmail or something. So the accounts are still secured, but the way that we interface with it could be something where there's a whole range of ways to interact. At the same time, there's also a wallet network. And this functions not in the sense of accounts, but in the sense of, again, almost like an email or the internet, like TCP/IP, where the wallets can talk to each other. It's a protocol for communicating between your pocket and my pocket. Nowadays, the protocol is I go up to you, say hello, hand you something, you hand me something, hopefully one of us doesn't pull a gun and rob you, the other person, and then run away, right? In the wallet space, we do that with a protocol, and the protocol has a security built into it that says the amount of units at the start of the transaction have to be the amount of units at the end of the transaction. If you come with 10 and I come with 10, and I want to give you 5, we go to the protocol and say turn 2 10s into a 15 and a 5, like you get cash exchanged at the bank teller. And the system goes, okay, as long as 20 equals 20, done. I don't know who you are, I don't know what you're doing, I don't know where you are, but as long as 20 equals 20, done. So we have a wallet network, we have a set of accounts, we have a cash, we have an issuer. Now let's get into the theory of issuance. Who's issuing it and why? What institutions are able to do it? And here is where there's a huge, long, complicated conversation about banking and shadow banking regulation. I wrote a paper called The Macroeconomic Implications of Digital Fiat Currency, which is online if you'd like to read more about my views in detail. But building on Torvald's point in the last panel, one aspect here is to be honest and upfront about the moral hazards and about the privileges that different actors are currently enjoying. So my father used to be a bureaucrat in the Australian federal government. He said the line there was, there's never time to do it right, but there's always time to do it again. So if we're kind of uneasy about the idea that we're kind of giving moral hazard to these actors, the sad truth is we've been doing that for quite a while and we're going to keep doing that while we keep feeling uneasy. So, there might not be, there might not be time to do it now, but there's going to be time, we're going to have to do it again and again until we get it right. And in that context, to think about all the different ways we structure legal privilege. It's not just the commercial banking charter and the commercial banking license, although that's a huge part of it. It's not just the fact that certain entities are given distributional access to land for colonial reasons or historical reasons, whatever, although that's part of it. But the idea of even shadow banking entities have limited liability structures. They have bankruptcy protections. There's a whole range of ways in which we're subsidizing the entire financial system under the assumption that even the most basic corporate form is seen to be a positive social good. We are subsidizing people taking on risk in the corporate form. When they go bankrupt, they don't have to bear that risk. We're doing that explicitly as a form of public investment. So leaning in to the moral hazard of regulating finance and having franchisees of different kinds of financial credit and activity that's ultimately backed by the government, and saying because we're leaning in, because we're acknowledging we're doing this, we're going to have regulatory requirements. If you're a financial actor engaging in financial activities, you're subject to the kinds of regulation, maybe not 100%, but close to the way that we regulate commercial banks. And if you want to tell us you're engaging in purely private behavior, we're going to call your bullshit out on that, because you're not. So that's how I would think about the relationship there. And we can go into a kind of Minskian conversation about how we value different forms of collateral and how we move away from a concept of market-based financial support, or the central bank as a market maker of last resort, and a central bank as a price maker of last resort of different assets. So that kind of connects to what I was talking about yesterday at the start of my talk, that the government is setting prices when it sets the unit of account. When it tells the difference between the food that you eat and the car that you buy and the house in terms of different price structures, it's also determining the relative price structures of different forms of financial instruments. That doesn't mean we can't have any market speculation for those prices, but we can set legally significant prices. In the same way as we have prices that people might trade, and then mark-to-market rules, where legally speaking, those mark-to-market prices are the ones that are relevant, we could come up with the equivalent of a legal price list for the financial instruments we want to allow to exist that reflect the social value and risks that we think are in those. And at that point, we are putting the analysis, the credit analysis, the institutional health analysis at the front end of our regulatory structure, not trying to deal with it when a crisis comes. I'm happy to go more into the conversation, and please feel free to talk with me, or if you want to check out these ideas. But yeah, the only last thing I'd say is that what we have to think about with this issue is not just starting from the problem in front of us, but starting from a vision that's sufficiently comprehensive and multi-layered that we know how changing one thing over here can affect the rest of the system. Thanks.
I've been told that perhaps Bjorn would like to give us some comments on the issues that were raised from a Norwegian perspective. So I invite Bjorn to start the debate, and then we'll move on to the questions from the audience.
Thank you. I felt the background of regulation as set out by the two interventions, and particularly by Sheila, is very accurate. I think we build on Keynesian, new and post-Keynesian philosophies in the way we regulate finance, both internationally and in Norway. You mentioned taxes on financial transaction. We have got that also in Norway. The last year, we have a special tax on financial activities, both on the wages in the financial industry and on the surplus. And this has been seen as one way to balance the kind of responsibilities the state, the government, do have towards financial industries, the privileges they have, and that then they should contribute extra to society. So even financial tax we have got. There is one item which I think we should have in mind. The best work on financial crisis is the one by Reinhardt and Rohan. They went through history of more than 150 years for more than 60 countries, and they found that the main reason for banking crisis was cracks in the housing market. It was property markets, boom and bust, and the regulations we have, they are not really fit to counter that kind of behavior. So, I mean, whether you have 5 or 8% own funds do not really help if you have boom and bust, because it has so many replications. So I think we have to supplement the toolbox with a preparedness of society to meet possible boom and bust. So what is presently done in Norway, where we have special regulation on housing loans, is not in the book, but it's being done pragmatically by the present government and the FSA. That is well in line with the thinking of Reinert and Rogov. Thank you.
Thank you, Björn. Would you like to comment before we start with the other questions from the audience?
Well, just again, it's so encouraging to hear about the Norwegian experience, and it's been very interesting to learn about it. Thank you.
I just say, Morgan Ricks, the idea that Torvald was talking about just banning certain kinds of credit activity, it sounds heavy-handed a little bit, but we do that with criminal activity. If we could just call certain aspects fraud and actually just regulate fraud properly, maybe there's certain things that shouldn't be being allowed to be done. So I think qualitative credit controls as a concept is one that needs to have a resurgence and a renaissance, because if we can talk about quantitative easing, we should be able to talk about qualitative tightening.
Very good. So do we have some questions from the audience on the topics that were raised? We have several people there.
Yeah, hi. I have a question for Sheila. You talked about this social contract between banks and central banks, and that kind of the deal was that central banks are allowed to regulate and investigate and control, and then in return the banks get to have like this lucrative business, which is to then borrow money and get interest rates. But I just wonder, isn't it a bit too lucrative? I mean, we're in this time or an era where we're always trying to get rid of the middleman and make things more efficient. And aren't banks just inefficient middlemen? Or to say it in another way, are there any good reasons for private banks?
Ben?
Yeah.
Mic to the lady in the middle. Yeah. You raised the hand first.
There we go. I'm rather preoccupied with pension funds, because when they get involved in banking and banks are too big to fail, politicians may think if the pension funds default, people will go into poverty in their old age. So if you didn't have the pension funds and the government just paid out the money, as people grow old, they just issue the money, would that be stabilizing to the system?
And the gentleman in the back? Then perhaps we can start answering.
Thank you again. There are so many great presentations in this conference, so I'm very happy to be here. If I try to understand the two of you, I think from my perspective, it's really about the different understanding of the limit of what the collective versus the private can do, or individual. My question is actually to Rohan, in a sense, because I think I follow you, and I tend to teach that prices are artifacts of institutions. So But still, I would argue to my students that there is something that is called, that is also real scarcity. So, I mean, there is a limit to how we can regulate through legal means or other means, or how communities can create norms, whatever, in the sense of building institutional structures. So I mean, I would like you to kind of elaborate a little bit on that, so because otherwise your argument could seem like being a bit over the edge.
Do you want to start?
Right, so shall I start? Well, first of all, the question about the social contract between central banks and banks being too lucrative, allowing banks to create profit. There is an argument for nationalising banking altogether. I mean, this is the idea of the state monopoly in money. It comes from a totally different place in a way, but there is an agenda that has been spelt out that really banking needs to be nationalised. It strikes me as a major disappointment that the British government, for example, having nationalised 2 major banks, I'm ashamed to say Scottish banks, that just treated them like private sector institutions, didn't use the opportunity to, have some influence within the financial sector in terms of culture and behaviour and so on. But if we go back to the 30s, in Canada, there were these 2 strains of reaction to the role of the banks in the Depression. Within farming communities, particularly where people's mortgages were being foreclosed. There was one strand which led to the full reserve banking argument that the state should provide money, and then the private sector can be left to its own devices, and that led to one political party. But there was another strand which led to another political party, which still exists, the NDP, which argued that, well, of course, banks are going to behave like that. What can you expect? And the only way to address the situation was to nationalise them, but to allow them to operate as banks. In other words, it wasn't a matter of bringing everything in-house. It was a matter of keeping the structure of banking as we know it, or as we knew it before liberalisation of banking, a sort of traditional form of banking, but the surplus went to the public sector, and that's a good vehicle for making sure that credit's directed in socially useful ways and so on. So I mean, there are other sort of more marginal ways one can, like having taxes on banks to deal with the surplus, but that nationalisation is certainly an alternative. On pensions, I mean that's such a good example of a sort of social issue that has come out of the financial crisis. The fact that pension funds have been under threat and some have collapsed. I mean that's a social disaster for people, and governments should be on the ball. They should be addressing this. I mean, state pensions arose from the idea that you needed to provide a stable income for people in retirement. But as wealth has grown, as financialization has continued, and as the state has sort of pulled back on providing benefits, the pendulum swung much more to the marketplace. Well, there's an example of where policy could try to address that problem. And I mean, it's a matter of priorities. Mm-hmm. Do you want to set things up so people's pensions don't go up in smoke? Well, that would be a very good idea. Mm-hmm.
Yeah, I mean, I think in terms of banking, I mean, I think there's a difference between saying are banks useful and is banking useful. So people don't always have a right to take whatever assets or wealth they earn and try to turn into something that earns more money. I don't think that's an intrinsic right or something that the banking system is supposed to provide. But banks do credit analysis, they do payment system management, and in some degree they're doing some sort of prioritization of investment as a sector. When you choose to invest in a casino, there are real resources that could be going into building a school that are not being used there. How much we choose to franchise out those decisions to a decentralized group of actors is a question of sort of governance and questions of centralization, decentralization. They're not intrinsic to profit or for-profit, or even public or private. You could imagine a series of decentralized non-profits operating a sort of civil sector credit union structure that does a lot of the credit analysis, and you have a government payments rails on which they do that, so the payments rails are being sufficed. So I think there is an important role of credit and decentralized credit and private initiative getting liquidity that they don't already have. I think the kind of positive money, monetary sovereignty view, it's almost like infants with object permanence. Like they can only talk about things in front of their hands, whereas finance is inherently contractual and temporal. In terms of pension funds, I'm from Australia, and we have compulsory superannuation on one level, so we just have forced savings. You don't even need that. You could just do it like Social Security and have it as a sort of welfare program. But I think there's also a flexibility aspect where these accounts come in. People want to choose to add more on that and top it up and things. But you don't need to have that in the private sector. You can guarantee those yields directly by the government as a matter of public policy. It's going to be the inflation rate plus 2% up till a certain amount of money, and then beyond that, less or something. And actually, the right-wing former treasurer in Australia said, I don't know why the hell we have these in private companies. This could be done just as easily by the government without all the grift, which is an amazing thing to hear a right-wing guy in Australia say. The other part there, building on the kind of Minskian vision of money manager capitalism, is the money managers that run these pension fund assets often mix it with other private assets so that the whole thing becomes too big to fail, which benefits those private actors. And also, the particular money managers themselves benefit from economies of scale because they get a 3% profit, so their vision is to get as many zeros at the end of the pot of money they're gambling with as possible, because then their 3% has as many zeros as possible. Which is why someone like Pete Peterson is obsessed with privatizing Social Security, because if you could take that huge pot of pension Social Security money and put it into money managers, that's sweet yield for them. The last thing about scarcity, there's two things here. One is, even the bloody orthodox people nowadays are talking about hysteresis and the idea that long-term unemployment can reduce the productive capacity of the workforce and individual workers. Conversely, a full employment economy where people are valued and employment opportunities are not as exploitive because workers have more value, and we are investing in things that are socially valuable rather than bombs and hate and discrimination and things. I don't think we know what the limits of our productive capacity are. I don't think someone had a great meme on Twitter the other day where they sort of brought Karl Marx into to the president and said, what do you think about Donald Trump? And he said, you went to the fucking moon? Like, what? So I think the idea that the capacity of us to produce and create new social outcomes is so far beyond our imagination. If we just got out of our own way and stopped, paying people to lock people up and then other people to be locked up and things like this, which is just a really huge waste. So I think there are real limits to scarcity of actual things. There's a limited amount of rare metals that go into microprocessors for phones and computers, for example. But that doesn't mean we have a scarcity of the concept of computing. It just means that we have to deal with that particular resource constraint in the context of a broader strategy of how we try to create computing outcomes or something. So I think it's not a matter of trying to hide the fact that there are real logistical costs, but it is trying to get past the idea that the most useful way of thinking about our potential is asking what we can't do.
Thank you very much. Do we have other questions from the audience? Yes, we have one there, and no other takers.
Thank you. This is for you, Sheila. We have a discussion in Denmark about different regulation systems. So, for example, some are proposing for a model following John Kay, where you separate not only retail and investment banking, but also investment banking into different sectors for like currency trading and derivative trading and etc. Then people following the sovereign money idea, they say, but it's too difficult to, in practice, separate banks like this. For example, the Danish Danske Bank is more than the size of a Danish GDP. So it's very difficult in practice to separate this bank, which includes all kinds of insurance and banking and investment and pension fund. They have all kinds of different functions. So how can you do this in practice, I'm wondering?
Well, first of all, each country's experience is particular to itself, so that in a way, I mean, it's a bit dangerous to do what I was doing, which was to generalize. And in particular, I mean, I guess I'm speaking from a British perspective, where banks traditionally have not been universal banks, and yet that's much more common in continental Europe. So that there isn't the same sort of recent memory of a segmented system in the way that there has been in the sort of Anglo-Saxon banking tradition. There are ways and ways of segmenting. I mean, even within institutions. I mean, this is happening actually in Britain with the ring fencing of retail banking. That it's not necessarily that new separate institutions are being formed completely divorced from the others. It's a way of ring fencing the activities. And that's potentially something that could be done in Denmark. But I mean, I don't know enough about the Danish system to say much more. And maybe I mean, it's a matter of judgment about what it's felt will work within a particular circumstance.
Thank you very much, Sheila, and thank you too, Rohan, for being our last panelist. So we have some Norwegian chocolate for both, I think. Now we're probably getting a little bit tired of it, but
oh, not at all, not at all.
So thank you very much for.
Thank you.